This week, though, markets were down over fears of a trade war triggered by President Trump's latest tariffs on imports. Another thing that's beginning to worry investors, though, is the timing of the next recession. There's actually a powerful tool used to measure when one might be on the horizon, and Wall Street is starting to notice. By the way, I don't want to alarm you with this. I just want to tell you about it. It's called a yield curve. In the simplest terms, it's a plot that compares interest rates offered on U.S. Treasury bonds. When investors expect the economy to grow, longer-term bonds, see, this is 30 years out here, tend to carry a higher rate than shorter-term bonds do. This is a normal yield curve. But when this yield curve goes flat, that means rates on both kinds of bonds, short and long duration, are about the same. This is the first sign to an investor that an economic slowdown may be on the horizon. People are betting on something like this happening. Now, lately, long-term bonds have been slow to rise. And at the same time, the Federal Reserve has been raising short-term rates, and that has resulted in the flattening that we're talking about. Now, if the yield curve continues to move in this direction, long-term interest rates could actually be lower than short-term interest rates. If you go to put your money into an interest-bearing account, you'll understand this, right? You should get more if you leave your money in for longer than you do. But if this starts to happen, this is called an inverted yield curve. The last time we saw one of these yield curves inverted, by the way, was right before the last recession hit in late 2007. In fact, this is the important part. Every single recession, these are all recessions, these thin green lines, these are recessions. Every single recession or economic slowdown for the last 60 years has been preceded by one of these inverted yield curves. That's why some economists are starting to take notice. Again, I don't want to alarm you. I'm just giving you stats here. The gap between now between a 2-year and a 10-year Treasury bond is about 1/3 of a point. The last time we saw that, the worst recession since the Great Depression followed soon after. Now, there were a lot of reasons for this recession that are not in place right now, but this is what investors and economists are actually watching right now.